Hi, welcome to my channel. One of the biggest bearish catalysts has recently made a comeback, and that's inflation. But that's not the only macro worry today, because there are far larger forces at work that we are not seeing that are unfolding in slow motion. Something much deeper than just a sticky inflation. The reality is there's a credit crunch the market might not be prepared for, and that's the US commercial real estate sector. Now, there are a couple of reasons why I still believe that the toughest challenge has yet to come for this sector. Now, take a look at this. Goldman Sachs recently published its research report on the US commercial real estate sector and highlights some of the big risks. You see, right up to now, the problem we are facing is that the share of US offices that's vacant in the top metro cities has hit close to a multi-year high, and not since the savings and loans crisis in the 1980s. And this problem could throw the markets off its tracks, something you might want to note out for. But first things first, let's take a step back and first unpack how we have ended up here today. You see, when you have an expansionary fiscal policy and the Feds lose monetary policy to kickstart the economy in 2009, it not only sent interest rates to near zero, but for the last 15 years, the Fed has launched a massive easing program. In 2009, you have QE1, in 2011, you have QE2, and 2013, you have QE3. Then, the worst came when the pandemic came that put the world to a stop. During COVID, the Fed had no choice but to launch a giant stimulus program that sent its balance sheet soaring with a huge amount of assets. That's more than $6 trillion in stimulus. In a short period of time, there's a huge amount of capital that flooded into the system all across the world. That forced inflation to go up. Now, here's where the Fed realized it wasn't prepared. So it quickly slammed the brakes by increasing interest rates. And that's where you see the market went haywire. But it was kind of too late. Now, I'm not blaming the Fed here. Even experts have also agreed that inflation wasn't what it seemed. And inflation has gone up to 9%. Supply chain was disrupted and everything went up. For the first time, the cost of property construction actually went much higher than US property value. This jump in interest rates caused a shock to the economy. And for the first time, money supply growth actually went negative. This further tightened the credit crunch. Now, here's the thing. The US commercial real estate is somewhat different from the US housing market, which we are seeing right now. Unlike the US housing market that has sidestepped some risk for now, this is because higher interest rates may not affect a 30-year fixed mortgage payment. And this jump in rates will instead cause a shock in the US commercial real estate sector. Properties that are borrowing now will have to pay a much higher variable interest cost. With all these buildings out there that has been struggling, borrowing costs now is much more expensive than the interest rates during the global financial crisis, which means it's more expensive for property developers, for commercial property owners to finance their properties. And don't forget, you have also COVID that basically lowered the physical spaces in office buildings. This has reduced the occupancies for offices and lowered the rental rates for these buildings. And the reason why is because people right now seem to be taking much longer to commute, especially after the pandemic in some of these big US cities. So for example, a prominent major Singapore REIT has reported that it has right now a much lower physical occupancy today. In fact, its overall physical occupancy levels as of earlier August stands at less than 60%. Some would go as low as 24 to close to 40%. And the thing is, you have all these properties that are paying lower rental rates. And on top of that, you have these properties are now paying a much higher borrowing cost. Bloomberg has mentioned that these commercial property values are getting hit hard by the Fed's aggressive tightening campaign, which basically increased the key cost of owning a property, and that's the expense of financing. So you get a double whammy where your rental rate drops, which results in lower profits, and your property valuation also results in some losses. Yet at the same time, your borrowing cost goes up, which means that the situation gets worse for US properties. But the biggest problem here is the lenders market, or the institutions or the banks which are lending out to some of this US commercial real estate, which I'll get to that in a bit. That's why the decline in occupancy rates has been more pronounced for the office sector versus the other types of US properties. Now, the risk comes with the lenders who lend capital to these properties. And this is what I really want to address. You see, the top US banks altogether hold about close to $9 trillion in assets. But these banks aren't at risk. What's at risk are the smaller regional banks that have been lending to this US commercial real estate. So how it works is typically large office buildings and warehouses borrow with non-recourse loans. So let's say if you buy a piece of property and the value starts to drop. Now with the high interest rates, what's going to happen is that property valuations is going to fall. And the owner of these commercial properties can choose to default on its loans and return the property back to the bank. So the bank now has no choice but to absorb the property with valuation losses on their books. So this problem comes when there are many of these defaults happening, especially when the main source of funding for the commercial real estate is coming from the US regional banks. So for instance, you have Brookfield, which has defaulted about $160 million of office property debt earlier in April, and these are located mostly in the Washington region. Brookfield also has issues with other properties in its other cities as well. So in fact, what Brookfield did was, because it has a non-recourse loan, it simply handed the property back to its lenders or the banks. So these banks then would have to settle for some of these properties where they have seen valuation losses. So most of this financing are considered non-recourse, which means that owners can simply just walk away from the properties without exposing themselves to the financial damage. So another one is Starwood, one of the very high-profile property owners and developers. They also defaulted on its debt, and they simply returned all these mortgages back to the banks themselves. Now, the problem is, although Starwood and Brookfield Asset Management, they are very big property players, and some of these defaults are considered small in terms of their assets. But the risk really comes when, if you look at the next year and in 2025, more than $1 trillion of these commercial real estate loans will be maturing. And this is where the risk comes, because if these properties choose to default on its debt, it can simply return all these properties back to the banks. And that's where the storm is brewing in the sector itself, because many of these properties' valuations have dropped, and these properties' values aren't worth anywhere near when they were bought, when interest rates were much lower back then. So because these properties cannot sustain the higher debt payments from high interest rates, as a result, these properties might have to foreclose, and the regional banks will have no choice but to absorb some of these losses. So there was a recent report saying that some of these office property valuations could fall as much as 40%. So some of these might affect the amount of credit or money these regional banks can lend out to small businesses, for example. And small businesses are what are the key drivers of any economy. While we might see persistent inflation and a tight job market here, the Fed is going to put off easing for now, which could continue to force a slightly weaker job market and sort of slow down the economy. This could result in less hiring and less spending. I mean, if we see many of the technology companies earlier this year are also cutting down some of their headcount. Now, having said that, where we are looking at some of the big risks in US commercial real estate, there is also some bright spots here, because while we are looking at much higher delinquency rates or higher default rates in offices, there are interesting bright spots in the other sectors, such as your industrials, retail, and hospitalities, where the delinquency rate or the default rates have sort of stabilized or at least come down. Now, what's interesting to note is that the newer properties tend to be more resilient than the older properties, which means that US commercial buildings, which are much older, tend to be at a much higher risk than the newer buildings here. So having said that, what I usually propose or what I usually share with my readers and community is that while we are looking at one sector like this, sometimes it's best to continue to diversify our portfolio into a more global portfolio, because when we look at some of these developed markets returns, there are some sectors, some stocks that tend to outperform other sectors or other stocks, and they might behave very differently at different periods. So it makes sense that while we might be looking at just the US sector alone, but it does not mean that we would avoid other sectors, other geographies, or other stocks as well, because different sectors, different stocks behave differently at certain periods. And since there are more than tens of thousands of stocks listed globally, we only need to find the top 1% of these businesses.